Positive week in the market last week. A lot of stuff going on this week. It's actually somewhat quiet, but there's some big earnings here that we're going to want to talk about in just a few minutes. A couple companies that I own, which will be pretty good to see for those who care about the short run. But remember, in principle-driven investing, we don't care about the short run. But before we get to that, up week in the market led to the ongoing bull market continuing its overvaluation run. And I get it. A lot of people probably like, come on, Paul, you've been saying it's overvalued for years. What is going on here? Yeah, that's true. Just like in 1996, when Alan Greenspan talked about irrational exuberance in the markets, and it took 4 years for markets to plummet. And since COVID, I've been saying it got pretty close to fair valuation. In fact, if you look right here, back at COVID, March 31st of 2020, we were only 35% overvalued, which was still a high number. And as of late, we've gotten to 117% overvalued on the stock market GDP ratio. And on the 10-year, cyclically adjusted PE ratio, we're 124.5% overvalued. Now, guys, I used to believe that overvaluation was a timing tool. It is not a timing tool. It is an expectation tool. It allows us to realize that when you pay a lot for something, your future returns are going to be less. This is just saying prepare for a lot of underperformance over the next 5 or 10 years. How it's going to happen, no idea. But guys, these are valuation measures that we haven't seen since the Great Depression. If you go all the way down in the stock market to GDP, all the way back to my initial data, back in 1928, we see 126% overvaluation in 1930. That is where we are right now. And guess what? The next 10 years saw a negative 5.3%. Guys, keep in mind, this was 2 years after the stock market crash of 1928 or 1929, whatever it was. This is very important to understand that, yes, valuations are important to observe, but if you dollar cost average into low ETFs, if you buy great companies at great prices, as those prices get better, you continue to add, realizing that you're building that portfolio for the long haul. If you're 5 or 10 years away from retirement, which is not as many of our viewers, but if you're that close to retirement, just make sure that you can withstand big drawdowns and a flat market for 5 or 10 years. And as you add money, as markets go like this, maybe over the next 10 years, your dollar cost averaging all the way along and your average price is here. That's what's important. And if you have the stomach, keep adding more, increase your additions as valuations fall. That's really an impressive way in which to make money. Because remember, if you bought at the peak of the 2000 tech boom in QQQ, the peak of March of 2000, it would go on to fall 83% before it bottomed. You'd have still dollar cost averaged and made 15% per year up until now. Now, granted, with that said, it's major overvaluations right now, but even if the QQQ fell 50 or 60% today, you'd still be in double-digit returns on an annualized basis, which is really, really impressive. Now, here are the companies that are reporting this week that I'm really interested in. Of course, Alibaba. I own Alibaba. Sprouts Farmers Market. I own Sprouts. Builders FirstSource is a company that I'm following. I don't own yet. But I look at these going, okay, these are companies that I just want to make sure, are they still doing what they're supposed to do? That's all I care about on quarterly earnings. I'm not looking at it as, am I right or wrong here? I'm looking at it as, has their business continued to go? There's going to be ups and downs along the way. But guys, another couple companies here, Coca-Cola, Walmart. These are big bellwethers in terms of what's going on in the world. Walmart especially. We saw Walmart really see same-store sales growth that really crushed as inflation was going up because people wanted to save money. But we saw other companies like Home Depot, Lowe's, and Target see same-store sales declines for a while because of that very thing, because people looked at them as more premium. Let's go back and focus on the things we actually need and to save money on those. Now, another company here, 2 more companies, Carvana. Guys, before Heidenberg Research shut down, they attacked Carvana saying, yeah, this might be a little bit of a scam going on. And of course, our favorite 84-page menu at the Cheesecake Factory. The average Cheesecake Factory does $12.5 million a year in revenue. How? I have no idea. I haven't been there in years. I actually like the food, but the portions are too big, and I just look at the options on the menu and I can't make a decision personally. Let's see what's going on in the economic calendar this week. A lot of home starts. Wednesday, we got housing starts, building permits, and then we have initial jobless claims like usual on Thursday. So there's some things here. It's kind of a slow week. Home builder confidence index is tomorrow morning at 10 a.m. Eastern time. These are what they're expecting, what was reported last. Housing starts has been a very, very important metric that a lot of people care about. Why? Because as rates skyrocketed, people were starting less and less. Home builders were starting less and less houses. They saw a slowdown in the amount of houses. I just went in a contract yesterday on a home in Dallas. It was not a new home, but it was built 2 or 3 years ago. And the seller was frustrated because right when they finished the home, they got a massive offer. I'm buying it for about 18% less than that offer. That was frustrating for them, but that's what happens with interest rates in the higher end market. So you've got to remember, these things all play together. But we all thought we'd see some major real estate crash when interest rates went from 3% to 7.5%, but you saw the opposite. Overall, the average home price went up. Now, in the higher end homes, yeah, those were real costs, real big cost changes for people. So I think it kind of slowed down that market there. But again, we're going to look at these things. We're going to understand where we stand in terms of the cycle because cycles are guaranteed. But remember, in 1975, the average interest rate was 9%. In 1985, it was 13.5%. And in that time, home prices almost tripled. All right, guys. So again, we talk about it over and over. Don't look at these short-term results as determining your long-term focus. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. We're here to teach that if that makes sense to you. And we want to be part of thousands of people in a community that are able to talk about this, analyze their stocks and companies with our tools, and really get a better feel for investing and sleep better at night. Because I get messages every single day over email, Instagram, Twitter, thanking me for our process. Join our community, $7 for 7 days at the link below or everythingmoney.com/sign up. I guarantee it'll be the best investment you make in yourself. Thank you for your time.